You ever wonder why banks call it a deposit? It sounds so comforting, like you're tucking your money into a warm, secure vault where it'll be safe and sound. But here's the ugly truth. That deposit is just a fancy buzzword banks use to make you feel safe while they're actually taking your money, slapping an IOU on it and sending it off to play in the financial casino. You're not securing your money, you're handing it over like a kid giving their lunch money to the school bully, trusting they'll give it back, someday maybe. And here's the kicker, while the bank is off gambling with money, inflation is quietly sneaking in and robbing you blind. With real inflation sitting somewhere between 12% and 15%, any interest the bank might toss your way is a joke. You're guaranteed to lose at least 10%, if not more. Think about it. You're actually paying the bank for the privilege of letting them gamble with your money, all while inflation steals more of it right under your nose. It's like handing someone your wallet, watching them burn half the cash, and then thanking them for the opportunity. We've been duped into thinking this is smart money management, but really we're just getting poorer while the bank laughs all the way to, well, the bank. Let's be clear. When you deposit money in a bank, it doesn't just sit in a vault for safekeeping. The moment the bank pays you interest, your money becomes a loan, and not the kind that benefits you. Yes, you're actually lending your hard-earned cash to the bank, and they're using it to make their profits, not yours. Banks take your money, invest it and lend it out to others, leaving you with nothing but a promise and a balance on paper. With the reserve requirement now reduced to 0%, they're not even holding a fraction of your money in reserve anymore. So while you think your money is safely stashed away, it's actually out in the world, at risk, fueling the bank's financial adventures. The balance you see on your bank statement is not your money safely stored in a vault. It's merely a record of how much the bank owes you. The real cash? It's out in the world, tied up in loans, investments, and other financial products. If everyone tried to withdraw their money at the same time, the bank wouldn't have enough cash on hand to cover it. They've already used your money to make more money for themselves. But wait, it gets even better, because here's where the situation goes from ridiculous to downright absurd. Not only is your deposit just a loan to the bank, but they've also figured out a way to charge you for the privilege of accessing your own money. You stroll up to the ATM, punch in your PIN, and there it is. Money, right? Wrong. There's a fee for that. Yes, the bank actually charges you to withdraw the money they're using to make their own profits. It's like charging a homeowner rent to enter their own house, but the madness doesn't stop there. Want to keep that account open so they can continue to use money? That'll cost you too. You're literally paying them to use your money while they rake in the profits. It's a business model so comically brilliant that it would make a con artist blush. And yet, we go along with it, month after month, as if this is how things should be. The joke's on us. The 0% reserve requirement, a dangerous new reality. During the COVID-19 pandemic, the Federal Reserve reduced the reserve requirement ratio to 0% for all banks. This means that banks are no longer required to hold any portion of your deposits in reserve. They can use every dollar you deposit to lend out or invest, leaving no safety net in place. In the past, banks were required to hold a certain percentage of deposits in reserve to protect against mass withdrawals, but now, with no reserve requirement, they're operating on a razor's edge. You might think that FDIC insurance protects you, but let's dig deeper. FDIC insurance covers up to $250,000 per depositor, per insured bank, for each account ownership category. This means that any amount above $250,000 in a single bank account is uninsured and at risk. Even more alarming, FDIC insurance only applies if the bank fails. It does nothing to protect you from the bank freezing your account during a financial crisis or limiting withdrawals, as can happen during bank runs or economic turmoil. Worse yet, the FDIC insurance fund only has about $126 billion to cover $10.6 trillion in insured deposits. If multiple large banks were to fail simultaneously, the insurance fund would quickly be depleted, leaving many depositors without coverage. The threat of bail-ins, your money could be used to save the bank. There's another risk you should be aware of: bail-ins. In a severe financial crisis, instead of the government bailing out failing banks, The banks could use your deposits to stabilize themselves. This concept of bail-ins was solidified in the Dodd-Frank Wall Street Reform and Consumer Protection Act after the 2008 financial crisis. It allows banks to legally take a portion of your deposits and convert them into bank shares, effectively turning your money into their equity. It's a way for banks to save themselves at your expense. If you think your money is safe because of FDIC insurance, think again. Bail-ins can affect anyone with significant deposits. A brewing storm, the unseen risks in the financial system. Adding to these concerns, the financial system is facing unprecedented pressures. At this moment, there is over $929 billion of commercial real estate debt that is due, along with more than $500 billion in unrealized losses from insolvent bonds. Plus, hundreds of billions of dollars are tied up in zombie corporation debt, companies that cannot generate enough profit to service their debt. These factors create a volatile environment where the stability of banks and the broader financial system is in serious jeopardy. The impending banking crisis, fueled by these immense and unsustainable debts, could make the 2008 financial collapse look like child's play. Banks are in the business of making money, not keeping yours safe. Let's be clear. Banks don't exist to keep your money safe. They exist to make profits. Their primary purpose is to create credit, buy and sell securities, and generate income from your deposits. They're using your money to fuel their financial activities, not to keep it secure for you. The more money you have in the bank, the more they can use for their gain, and the greater your exposure to risk. The real risk. What happens in a financial crisis? In times of financial instability, the risks multiply. Banks may restrict access to your funds or worse, fail altogether, leaving you with a fraction of what you thought was secure. This is not just a hypothetical situation. Banking crises have happened before, and they can happen again. If the economy takes a downturn, you could find your assets frozen, inaccessible just when you need them most. The more you have concentrated in traditional bank accounts, the greater your exposure. The solution: protecting your wealth with gold and silver. Given these risks, it's crucial to take proactive steps to protect your wealth. Gold and silver offer a level of security that traditional bank accounts simply can't match. No counterparty risk. Unlike your bank deposits, gold and silver are not someone else's liability. They are tangible assets that you own outright. Inflation hedge. As the value of currency declines, gold and silver increase in value, protecting your purchasing power. Crisis-proof gold and silver have been a reliable store of value for over 5,000 years, surviving economic upheavals, wars, and financial crises. Don't let the banks roll the dice with your savings. Gold and silver are your financial anchor. Let's face it, we've all been duped. For years, we've bought into the idea that our money is safe in the bank, thinking those numbers on a screen or that piece of paper are as good as gold. But now that the curtain's been pulled back, it's clear we've been playing a game where the house always wins. And guess what? We're not the house. The truth is, those deposits aren't deposits. They're loans. You're lending your hard-earned cash to the bank, only to be charged fees to access it, while they use it to line their pockets. It's like paying a toll to cross a bridge that you already own. The more you think about it, the more ridiculous it seems, right? But here's the twist. You don't have to keep playing this game. There's a better way to protect your wealth, and it's as old as money itself: gold and silver. Unlike that IOU your bank likes to call a deposit, gold and silver are real. It's not just a number on a screen. It's a tangible asset that you can hold in your hand, something that isn't tied to the whims of a financial institution. Gold and silver aren't just about wealth, it's about privacy, preservation, and protection. It's the ultimate safe, locking away your wealth from prying eyes, market crashes, and the insanity of a financial system built on IOUs and empty promises. With gold and silver, you're not just securing your money, you're taking back control of your financial future. So it's time to stop being the punchline in the bank's joke and start making smarter choices. Ditch the illusion, embrace the reality, and let gold and silver be the bedrock of your financial security. You'll thank yourself later, and sleep a lot better too. For a free, no-obligation conversation where we'll help you explore how to better protect your wealth and ensure your financial peace of mind, please give us a call at Swiss America today at 1-800-289-2646. That's 1-800-289-2646.